They are panicking. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, the banking elites panic as an unexpected economic shock is about to crush the global economy. And I want to understand that things for the banking elites have not gone as planned. They had hoped through a strategic maneuver to turn the global economy around and engineer the impossible of a soft landing. But based on the data we got today, it's now become evident that the global economy and the U.S. economy are now a matter of months away from a recession, and this has panic spreading through the heart of every central banker around the world. But it's not the only thing we're seeing a downturn is. We just got some news from one sector of the U.S. economy that everybody said would lead the U.S. economy forward. What this suggests, as we predicted accurately, is the worst is yet to come. Now let's head over to Bloomberg, where he picked today's story up with a headline: Is 3 ECB cuts now more likely in 2024? And this is important to understand because with the economy is strong, you don't need to cut rates that much. And the plan all along for these central elites was to put rates into restrictive territory, which they claimed they did. And then as they approached their target, they were going to back off a little bit. But now that we're seeing 3 rate cuts potentially coming out of the ECB, it tells us, as we've already known, that the Eurozone economy is in far worse shape than they want to admit. And here we can see from the Bank of Greece, they reviewed Eurostat's recent inflation and growth data. They now consider 3 rate cuts in 2024 as a more likely scenario. Inflation numbers are consistent with the ECB's most recent projections, but first quarter output figures were a positive surprise, as according to the Greece's central bank chief. And if this pace of economic growth continues, then consumer price growth is likely to be marginally higher than our March forecast, but without jeopardizing the 2% target in mid-2025. The reality is they're going to hit their 2% target long before we even get to 2025. They just don't realize what's coming for the global economy, and has everything to do with what just happened in the U.S. today. As data earlier this week revealed that the slowdown in the Eurozone inflation stalled at 2.4% in April, even as gains in the services prices eased. At the same time, gross domestic product in the January to March period rose by 0.3%, which was the strongest in 1.5 years. But as you can see, there is actually a link between, of course, the economy and inflation. And you can see as we look at the U.S. data here, we're going to look at the consumer price index, which is, again, a proxy for demand against gross domestic product, both shown on a year-over-year rate of change. And with the exception of the early 90s and the global financial crisis, what you can see very clearly is demand, again, the consumer price index, leads the broad economy. And what we can note is that inflation, while it did rise briefly in the early 90s, it came down thereafter. And if we look at the global financial crisis, we note that what drove inflation was the energy sector here, while the rest of the CPI came crumbling down. And when the energy market broke, well, we ended up in deflation. And so what we can see here is a very clear issue that the global economy is slowing. Now, I want you to understand what the plan was, is to let, of course, the central bankers around the world cut rates against the U.S. And this is very important because the way the global economy works is dollars flow out of the U.S. into the global economy. But at this point, because rates in the U.S. are so strong, that means money is flowing the opposite direction. So the key here is if the U.S. consumer stays strong, and you see, of course, the consumer prices and producer prices in other parts of the world go down because their currency is falling, well, that means we're going to see a shift in production and manufacturing and demand go overseas. That will take dollars with it, and then you start to see the turnaround of the economy. But what's the key part to this? Well, it's a U.S. consumer. And here we can see the ECB appears ready to cut rates when policymakers meet in early June, but remains unclear what their subsequent moves will be. Of course, no central banker will predict anything. Some are looking for back-to-back steps, while hawkish officials have been a little more cautious. But one thing you should be very clear about, and that is your subsequent move when it comes to trading, because yesterday our reports put out a 100% success rate. If you bought everything our reports recommended yesterday, you were in the green across every trade. And if you think it can't be that easy, it is. And look, we don't ask you to be a professional trader. All you have to do is follow our signals. Look at this. Going back almost 2 months from March 11th to close of business yesterday, our CTA Timer Pro had a 65% win rate, Momentum Timer Pro 79%, meaning if you bought everything it recommended, you'd be up. That success rate is huge. Most professional traders, they barely even get close to 50%. Our reports give you the edge. What's the difference is we look at the machine positioning, but we run a historical overlay. Shows you when they're off sides because we want you to buy before the machines do. We give you the report, give you the video. Maybe you trade the technicals, no problem. What you find out is you get in late, you get out early, you're all over the place. We take all those signals, aggregate them together, run a proprietary overlay, give you the signals and a video every day on how to trade them. And that is the key to your success. You can get a 30-day free trial. My buddies, they charge you for the first month, not us. 30-day free trial, links in the description below. Change how you trade. Start making money, because when you understand now, the key here was the U.S. consumer all along. As long as the U.S. economy stayed strong and robust, what you would see is price pressure switch as, again, cheaper manufacturing due to cheaper currencies and other parts of the world would drive dollars out of the U.S. economy where they need to be flowing and turn the global economy around. But one thing changed, and in a big way, and that's the U.S. labor market that literally every banking elite has pinned the hopes on. Here you can see U.S. jobs post the smallest gain in 6 months as the unemployment rate rises. Payrolls now rose 175,000 on weakness. Get this in construction and leisure. You think about leisure heading into, of course, the summer months, not a good sign here. Wages grew 3.9%, should be said, slow to 3.9% from April of last year, the slowest in nearly 3 years. That is something we predicted very clearly, because what did we say? If there wasn't demand in the labor market, you'd see price for wages come down. We note that there's too many people on continued claims at this point, too many people coming back into the labor market due to high inflation. It all makes perfect sense. As Friday's report signaled further evidence, the demand for workers is moderating, but the data doesn't likely amount to an unexpected weakening. Well, it never does, according to, of course, Fed Chair Jerome Powell said that would cause him to warrant a policy response. They never see a crisis coming. Powell, who spoke Wednesday after the central bank held interest rates steady for a 6th straight meeting, notated that wage growth probably needs to move down more incrementally for policymakers to meet their inflation objective. And there's some truth to that, as Friday's report showed some movement in that direction after a slew of releases early in the week suggested wage pressures continue to bite. It's all because demand is going down. You think about it, when new orders go away and you see people spending less money, well, that means, of course, employers don't need as many employees. They don't have to give out as many raises, especially when they can look out at the unemployment line and see a long list of people waiting for a job. And here we can see the link between the Consumer Price Index and average hourly earnings of production and non-supervisory employees. That's shown in red. And what the Fed wants is for you to see fewer wage gains. That's important to understand. That means if you have less money in your pocket against inflation, you can't spend as much. That brings demand down. Fed's got it backwards. They should be trying to focus on bringing production up. Here you can see a steep drop here in average hourly earnings. This is going to come back down to what I believe is somewhere near the median, which is around 2.5% to 3%. If that does, watch out. Inflation is going to go away in a big way. And here you can see average hourly earnings climbed 0.2% from March and 3.9% from a year ago, the slowest pace since June of 2021. Some economists were expecting a stronger increase, in part due to a new California law mandating a $20 minimum wage. Of course, that meant demand there is likely going down as well. And what do you see the market response? Well, yields fell and the dollar fell. Why? It makes sense because the market's pricing in the Fed cutting rates sooner than expected, while the S&P opened higher, as of course the market believes that any form of rate cuts remains bullish until, of course, the Fed is cutting rates due to a major downturn. And here you can see, when you look at the bigger picture and start adding in average hourly earnings, and here we see in total compensation now shown in red, that's average hourly earnings multiplied by average weekly hours of production and non-supervisory employees. What we see is a continued deceleration in total compensation at a time when debt service costs are through the roof and inflation still remains high. That means demand indeed coming down, and that's that's why we're seeing the demand for labor slow down, suggesting the non-farm payroll report in the coming months is going to continue to decelerate. And again, you come back to what we're trying to understand here with these banking elites is they wanted to create kind of a mismatch to drive dollars out of the U.S. into the rest of the world. The problem is no one expected the U.S. economy to slow down, and the problem is it's slowing down in a big way. As job growth slowed within leisure and hospitality, and not what you want to see going into the summer months, construction and government as well. Payrolls declined at automakers and temporary help providers, and that's a big one because when you see temporary help start to drop, that is a big sign for lack of demand for labor, because when temporary help is rising, well, that is a positive sign suggesting employers are looking to rent employees before they hire them. Right now, they don't need them. That's an issue as gains were concentrated in healthcare, transportation, and of course, retail trade. And President Joe Biden, well, he's going to have a big problem with this report, even though he's been touting the recent strength of the job market as evidence that his policies are helping the economy. What he can't see is, of course, as wage gains are coming down. He pointed out the unemployment rate has been held below 4% for over 2 years, according to a statement after the report. Well, Mr. President, I've got some bad news for you. The unemployment rate's likely to go a whole lot higher. And here you can see the evidence. If we take the last chart, which is a CPI in blue against total compensation in red, now we're going to add the unemployment rate in green. And when you see periods where total compensation growth is slowing, and you see the consumer price index, again, proxy for demand coming down, or the unemployment rate goes up, you can see this happen each and every time it leads into a recession. And right now it's remaining very low, but at the rate we're going to see a continued deceleration in total compensation. Well, watch out. If we see demand drop off in the CPI, the unemployment rate's going to go up, and that is not the news a president wants to hear at all about the economy as he faces a potential re-election in November. As a jobs report is composed of 2 surveys, because the other one says things are far worse than even the one now says is one of businesses that generates payrolls and wage data, and another smaller one that households use to produce the unemployment rate. The household survey publishes its own measure of employment, which rose just by a mere 25,000 in April after surging by nearly 500,000 the prior month. It may revive questions of why such a large gap between this figure and the headline payroll number as there. Nobody seems to know. But when you dig deeper, and this was almost in the footnotes of the Bloomberg article, look at this. Weekly hours worked edged down 34.3. The underemployment rate, a broader measure that includes those who prefer full-time work, rose to the highest since November 2021. The rise in unemployment mainly reflected people who lost their jobs. That's not a good sign, as opposed to people who quit their jobs and couldn't find work. And the number of employees working part-time for economic reasons climbed to the highest since June of 2021. Perhaps a sign of emerging stress in the labor market, and starts to become very clear why we're not going to see an increase in average hourly earnings at all. And so you see underneath the shiny veneer that everyone has been touting is the strong and robust labor market here in the U.S. You can see the cracks in the foundation starting to get bigger and bigger, and showing up right in the services sector. Here we can see the U.S. Services Index shrinks as activity gauge. It's a 4-year low. Now keep in mind, everyone said the services sector was going to lead the economy, lead the manufacturing sector. We said that's not how it works, and sure enough, it isn't. Here you see it's now in contraction at 49.4. Nobody said again that was likely. And that gauge of services again fell to 49.4, the lowest since December of 2022. Readings below 50 indicate again a contraction. The business activity index, which parallels a factory output gauge, slumped to 50.9, just meaning a very slight expansion, the lowest level since May of 2020, when the economy was reeling from pandemic-related shutdowns, if you can imagine that. And here we can go on to see the measure has been steadily picking up over the past 6 months, and if weaker readings persist in the coming months, it could raise concerns about a broader slowdown in economic growth, because the services sector It's the largest part of the economy. And we've been making the case when you put people on unemployment, we have just under 1.8 million people sitting on continued claims. We're seeing a slowdown in the manufacturing sector. We just saw that from the ISM and S&P Global, that the services sector would fall, and nobody said this could happen. And even at worst, I was willing to admit that I was potentially wrong for a period as we head into the summer months, which is usually a big driver for services. Now we're seeing, in fact, something changing in a big way. As employment contracted in the services sector for a third month now in a row, that is dangerous. You would not expect to see that. The data followed government figures on Friday that showed the slowest U.S. payroll growth in 6 months. And while labor demand is moderating, the report likely doesn't indicate an unexpected weakening. Well, we'll see about that. Well, there's no question there is going to be an unexpected weakening. We'll see that now in a matter of months. And at the same time, on the inflation side, and of course, if you're wondering why that is, well, you see these usually higher paid jobs, people get a severance package. Do you know what people in the services sector tend not to get? Well, they don't tend to get, of course, a package that keeps them off unemployment. The index of prices paid for materials and services increased to a 3-month high. So what we're seeing is inflation going up, demand coming down because consumers cannot afford higher prices. The pickup is similar to the ISM gauge of manufacturers' input costs. That climbed to the highest level of 2022. So here you can see inflation driving higher in the manufacturing and services sector against weakening demand. It all comes back to total compensation. Consumers cannot afford these higher prices. The Fed has met its objective. They wanted to crush demand. Well, they're doing it, but that's going to send the economy into a recession. As a gauge of new orders placed with the service providers, evidence that demand is going down. It fell for the second month to the lowest since the end of 2022. And here you can see when you see, of course, total compensation shown in red going down, and you see periods where there's higher inflation or even where inflation's coming down. What happens? New orders here. This looking at the Philly Fed new order index, and here you can see again green line going down as total compensation goes down nearly each and every time. As we look at this, we're going to expect this to roll over in a big way as demand starts to plummet, and all it's providing evidence is that consumers are cash strapped here. Demand's coming down. They're not able to spend as much. We predicted this is exactly what was going to happen. And meanwhile, an index of inventories of service providers increased to 8.1 points to a 5-month high, suggesting people can't afford these higher prices. And gauge of inventory sentiment reached the highest level since July of 2017, indicating companies see stockpiles being too high. A sustained build in inventories would risk tempering production and manufacturers in the coming months, which would simply send more people on the unemployment line. And one comment out of that ISM services report summed everything up quite nicely when they said business remains soft. And the problem is it's soft before it gets worse. And now you can see why these banking elites are panicking, because nothing they planned is going according to it. And now they're facing a global recession in a matter of months, which is completely unexpected. I'm your host, Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.